All right. Live Monday night, 6 p.m. Pacific Standard Time. Let me know if you can hear me. I'm a little farther from my mic than I usually am, but I think we're dialed in. We got the same computer. We got the same mic, same time, different location, but I'm here to answer any questions you may have. So fire them away. First and foremost, please, for the few of you that are on, let me know what we've got sound wise. Dorothy, thanks for joining us. You were here early and already popped a question in there. And so what happens when I add my boyfriend to title? Does he have the same rights as I do? If it's a boyfriend and you're not married, unfortunately, it's going to be hard to add him to title if he's not on the loan. Let me know if you can hear me. Let's see here. Audio. Testing. That seems to be working. And then I've got, I'm going to do that. Makes it easier for me. All right, cool. Let's see if that works. All right, cool. Flashlight sound is fine. It's like rather than have this microphone sitting up here on my desk like I normally do, I got it sitting off to the side, but same mic. Kim Narciso, thanks for joining. As always, I'm just going to spend as long as it takes. Last week, we did 2 hours and 5 minutes of just answering questions. 50, 60, 70 people were on. I think we were in the 70s at our high last week. And we're just talking mortgage. We're talking the real estate market. I'm not holding anything back. I'm going to tell you my honest opinion about what's going on in the market, what's going on with mortgage rates, whether I think that, we're going to see a housing crash. I actually just recorded a video talking about comparing 2021 to 2006. A lot of people make that comparison. They see the run up in prices in 19, 20, and 21, like we saw in 04, 05, 06. Doesn't necessarily mean that we're going to see the same thing happen in the real estate market that happened last time, because if anybody remembers what loans looked like in 2004, 5, and 6, no income, no assets, 100% financing, credit scores in the 500s, it was no holds barred. And if you compare that to what the lending standards are now, where not only do you have to be much more qualified, but you also have to put a down payment. You also there's light years better, right? And once you do get qualified to buy a home in today's market, it's going to be a fixed rate mortgage 99% of the time. I think the stats for adjustable rate mortgages was over 50% in 2005 and something like 2.2% today. So safer mortgages, more qualified buyers. That's one of the things I bring up in tomorrow's video. I'm happy to go into it, or you can just wait till tomorrow, 1 p.m. Pacific Standard Time, where I give my little 9-minute spiel on why this market is so much different than the 2009 market and why any doomsdayer that says we're going to have a huge housing market crash is, one, trying to get views on YouTube, or two, out of their mind. Sometimes both. Hello, Linda Gomez. How you doing? Good to have you here. Thanks for checking the sound for me. If there's any ever issues with audio or anything, let me know. I was worried about Wi-Fi. I was worried about my mic. Everything seems to be going off without a hitch. So, yeah, good. Dorothy Jones, why does it take so long to get a refi? I'm over here going crazy. Well, you don't look at my Instagram feed then, because all you'll see there is clear to close in 17 days, clear to close in 22 days, clear to close in 15 days, a bunch of happy clients closing their loans really quick. And I'm not sure, you'd have to get specific on what the holdup is. But let's start with, who are you using to get your refinance done? Is it a bank? Is it a credit union? Is it an online lender? Is it a local mortgage broker? Is it a direct lender? Then from there, I might be able to help you piece together why it's taken so long, get you some answers, and maybe point you in the right direction if if you need to go elsewhere to seek a loan, because it shouldn't take long. Mortgages are not any harder than they have been in the past with getting done. And so everybody I know who knows what they're doing can package a loan up and get that thing to the finish line in 3 or 4 weeks tops. LB, I am with you, man. It surprised me too. If you would have asked me, and for anybody who's wondering, the 10-year note went to like 1.21 today, I think. I'm not exactly sure. I was not in front of a computer all day, but I would have bet when it was at 150, if you would have told me, does it go to 2% first or down to 1.2? I would have bet a lot of money that it went to 2% before it went to 1.2. And so I'm as surprised as you are. And it goes to show you, mortgage pros, folks that are just watching the market and just, have an interest in that stuff, we don't know what's going to happen. It's wild. Jennifer Sabino, good to have you here. Let's talk about this. And I don't have any graphics I can throw up there. Well, maybe I do. Maybe I lied. I'm going to show you something, Jennifer, and give me a minute while I talk through this. I'm just pulling up on my computer so I can show you like real, true pricing, right? And vast majority of the time, it just does not make sense to buy points. But this is something that I get into real detail on the course that I'm putting out because it's important. And people don't understand it. And what happens is they get put in a loan that's not the best loan for them. So we're going to talk about a $300,000 refinance. So this is a $300,000 loan. Nice round loan amount so we can use round numbers. And here's what I'm going to do. I'm going to show you the whole rate sheet. I'm going to talk through why it probably doesn't make sense to buy any points. Control plus, plus, plus. Let's zoom in on this bad boy. Okay, where are we at here? This is the fun part where you guys get to see behind the curtain, right? Share screen. I'm used to being with 2 screens. Let's see if this works. Share. Wow. A screen of a screen of a screen of a screen. Boom. All right. Do you guys get to see that when I share this? Huh. Man. Hopefully you guys are seeing this rate screen. I'll talk through it. If you guys don't see this, then you're going to have to close your eyes and envision it. But this $300,000 loan with a $1,212 payment, you can get a 2.67 if you've got great credit with no points at all. This middle right here is the points. 0 points, 2.671 interest rate. If you wanted to go to 2.625, you would pay 0.32. It's about a third of a point, $960 cost. You would save about $7, $7.26 if anybody wants to check my math. So how many $7.26 months would you have to save to break even on $960 over 10 years? I can tell you that rough math, that $7 times 120 is going to be less than that, right? And so we can do the same math going from 2.67 to 2.5, 884 points, $2,600 cost, and that is $27. It's almost a 100-month break even. Never am I going to spend today's dollars, $2,600 in today's dollars, to save $27 a month on future money that's worth less, inevitably, right? So that's kind of the gist of it, right? If you're going to pay up front for, oh, you saw it. Okay, cool. Yeah. So my point there is it's all math, and it's really easy to look at. What people don't see is that somebody offers you that 2.5 or 2.375. Wow, that's amazing. A 30-year fixed at 2.375. And I'll look at it real quick. $4,700 cost. Well, if you called a big online mortgage company, and I won't name any names, but like Quicken, they might send you these 2.375, and they're charging you even more than I am, quite honestly, because they got advertisers that they got to pay. So they're charging you $6,000. And I know the math. I know it's going to take you 10, 11 years to break even. You would never, ever do that. But the low interest rate lures people. It looks so gosh darn good. You get to brag around the water cooler if you're back to working actually in an office and not at home. And so hopefully that helped answer your question, Jennifer, is that you'll always have that whole rate sheet. And I'll share it again real quick, because this is how every single scenario is going to look. And it might not look the same. If your credit is worse or the scenario is different or it's a cash out, it might look different. But you can choose whatever rate you want. I can give you 2%, no problem. You're going to pay $12,500 in points to get it. I can give you 2.25. 30-year fixed. Sounds great, right? Not really great. $7,000 in costs. Generally speaking, this rate that is attached to 0 points is going to be the best bet. Here's the thing. I say generally speaking because this stuff changes. What if this 2.5 was only 0.5 point or was 1/3 of a point, like this $960 cost, and then it could break even in 3 years? Then I would tell you go for it. It changes all the time. Lenders adjust their rate sheets based on a billion things. So today, from what I'm seeing on rate sheets, it doesn't make a lot of sense to buy down the rate. If you're on fixed income and the extra $37 a month is vital, something like that, there are scenarios here and there where I have people that want to buy points, and I understand why, right? But thought I stopped sharing. Here we go. But generally not, right? Just in an environment like this where we're going to see inflation, I'm almost positive of it. Don't spend today's dollars chasing a $17 savings on payment number 78, because 1, 6 years from now, you might not be in the loan. 2, your dollars are worth less in 6 years. I promise you. I promise you that. Good evening to my buddy Kevin Hawthorne out in Florida. Appreciate you for always joining us, man. Hope you're doing well. Kim, thanks for joining us. How is buying a house with solar panels that are leased affect your DTI? You know what's funny is when we have to get those solar leases transferred to you, I don't think that we hit your DTI with it. Am I wrong? Matt, the mortgage guy, doesn't have always all the answers, but here's what I did. I brought my digital notepad. And I've done this before where I've wrote down questions. I forgot to circle back, so I apologize, but that's why I brought the pad tonight. Do solar panels leased calculate in DTI? The only thing that I can remember is like the solar company gets an authorization from you. They want to run your credit, make sure that you're like credit worthy to get that lease transferred. But I don't think it hits your DTI. I feel like I've had that happen multiple times where it's at the end and we've already like approved the file and it doesn't go back into underwriting. I may be wrong. I'm not always right, but that's my guesstimate. All right. 719 notes. I'm gonna get all these questions answered so I can be lured. Man, this is a popular one. People are looking for products that are for 2 to 4 units that aren't FHA. And I know what you're thinking, face too much. You want to put a small down payment like you do with FHA and buy 2 to 4 unit. Unfortunately, nope. That's the only product where you're gonna be able to put less than 10% down and buy. On a 2 unit, I think you can do 15, but nothing anywhere close to 3.5% like FHA. All right. Theo, good to see you, man. Thanks for joining. Dorothy with Loan Depot. I wonder if there's Loan Depot. They've got like retail branches, and then there's people that broker to Loan Depot. But I don't know if it's an issue with your file, if it's an issue with your loan officer. Refinances don't take that long. But I'll tell you this, and I'm not claiming this is you because you could be great. I've had people come to me like, man, I've been in process with this lender for 2.5 months. I can't get this loan closed. And they start with us. And I'm like, no problem. We'll close this thing in 30 days. It takes them 4 days to sign their initial disclosures. It takes them 19 days to get us back any documents we asked for. It took them 7 days to pay for an appraisal. And I'm like, I wonder why it took 2.5 months with the other lender. So if you're holding up your end of the bargain, you're getting stuff turned in and you're on it, then either the lender is crappy, which is possible, or it's a complicated file. You might be self-employed. There might be some other things that are just making it a more complicated file. But best of luck to you. If you want to, shoot me an email, matt@mattthemortgageguy.com. If you prefer not to air it out here live, and I can look at it and offer you some advice offline. But if you don't mind airing it out, air it out, because I'll gladly answer based on like your specific scenario, what's going on, what seems to be the holdup when you ask the direct question, like, hey, what's going on with my loan? Why aren't we progressing? They've got to tell you something. You owe me more docs. I'm having problems with underwriting. We're no good. If they don't respond at all, that's a bad sign. All right, Patricio, a difference between a traditional refinance and a streamline refinance. Streamline refinance, FHA has a product, FHA Streamline, and then the EARL, which is a VA loan, a VA interest rate reduction refinance loan, something to that effect. RRRL. Are both loans where the streamline part of it is they don't need to re-verify income and do a full underwrite like they do on all other refinances. It's just a mortgage credit score, a couple of documents, and then it's a streamline loan. No appraisal, no income verification. They're really easy loans. You just have to make sure they make sense. In today's environment where everybody has so much equity, it's getting harder and harder for FHA Streamline to make sense, just because we've got enough equity. You should be able to remove your mortgage insurance, and an FHA loan is always going to have mortgage insurance. You want to be careful of that, like padding more fees into your new loan, continuing to pay mortgage insurance, because even if you have a 660 or 680 score, if you've got enough equity, you could remove mortgage insurance and do conventional. You probably want to do that. So I would consider looking at a conventional. If it's a VA EARL, those rates are fantastic. And if you've been sitting in a VA loan for any length of time, you've probably got a rate in the 3s or maybe even the 4s. And those VA rates are smoking in the low 2s. All right, Theo. I've referred my sister to the program. She's out of state. Fill out the form and hasn't been contacted. Bro. Don't they know that's Leo's sister or Theo? My bad. Shoot me an email with her name and info. I've got a bunch of good feedback of people getting responded to. So if your sister's not getting responded to, heads are gonna fly, bro. I'm gonna talk to my people over there. I'm guessing, but low 2s. If you're doing I guess it depends on the loan. Depends on the loan. Depends on your credit score. If it's a purchase versus a refi. If it's a streamline versus a regular FHA. But all FHA rates are in the 2s. Low 2s for purchase and for refinance. probably mid twos for a Streamline, because you need to take a rate that offers you enough credit to cover most of the costs. You don't bring a bunch of money to close on a Streamline. It's very volatile. You're right. But you see stuff like today, Albie Alexander, where the 10-year note goes to 1.21 and rates get even lower, and you're like, score one for the good guys. I'm with you. What are we, 5 months away? August, September, October, November, December. Yeah, if I was you in your position, I would feel how you feel. It's volatile. It's like, man, I wish I could lock 5. Just all the options for 180-day locks just aren't good. And that's the problem with your specific scenario. Here's what I would do if I was you. I would just get in the mental state of like, I'm okay with a 3.125, even though rates are much lower, because that might be like, I think I predicted 3.5 by the end of the year, but the way things are trending and the way things are, I would highly doubt that in 3-4 months from now, they get above 3%. I don't know. Whenever I say something like that, then I get proven wrong. But if you're closing in December, you can lock on a 60-day at a good price in October. So you really only have to sweat for 3 months. And in 3 months, if you're 2.7 now and it goes to 2.99, you're still in a great spot. So I'll be crossing my fingers and my toes for you. Andrew Brown. Looking at a 6-unit investment property. Is there any workaround? Does it have to be 4 units or less? Okay, great question, Andrew. This is something I can elaborate on so that everybody learns a little something tonight. And 6-unit investment property is always going to be a commercial loan. And as I know, investors follow me. I'm an investor myself. I work with a ton of investor clients. This is a great question. 1 to 4 units, always going to be residential financing. And that's my specialty. That's my lane. I'm dealing with people buying single family. I'm dealing with people buying duplex, triplex, fourplex, all kinds of different loan programs for them. If you have 5 units or more, no exceptions, Fannie, Freddie, all the places where we're sending these 1 to 4 units are not going to take the 5-unit plus. It's always going to be commercial. And it's important to note that when you're buying 1 to 4, you've got to have income, assets, credit. You've got to have that whole package, your personal ability to repay. And that's how you're going to get qualified for the residential mortgage stuff. When you get to 5 units and above, commercial lenders look at the asset. They look at the building and they say, what does this building create monthly in cash flow? They still want you to have good credit and good financials and whatnot, but they're really looking at the building and how well the building performs. And, where a lot of people get in trouble is they're trying to buy a building as a value add where they can raise rents, they can do some renovations, they can do whatever they want. If this building's only getting $4,200 a month in rents, but you're like, oh no, this 6-unit, I could rent these for $1,800 a piece. So I could get the rents way, way up. I could double the rents, right? Well, they're looking at the current rents in the trailing 12, and it's going to be hard, at least from what I know. In my limited knowledge of commercial and that whole space, it's a whole new animal, and it's going to be based on the performance of the building. A lot of these smaller ones, like I've looked at these 6, 8, 10, 14 units. A lot of them are mom and pop landlords. Their accounting is absolutely, I shouldn't talk smack about it because I'm not the best record keeper either, but chicken scratch accounting, back of a notepad type stuff. That's going to be hard to take to a bank and say, hey, finance this building. It's a winner. It's kicking off enough income. I'll be able to pay back. So that's some advice you didn't ask for, but I threw it in there anyway. Little bonus. All right. Dorothy said she could see the rate screen. Flash of Light said she could see the rate screen. Appreciate you guys. Hopefully that points to buy or not to buy was helpful. All right. Yeah. Shoot me an email, Theo, matt@mattthemortgageguy.com. If she filled out the form and nobody responded, I could either ping them and they do a great job, or I could connect you with somebody else in Texas. But I'll get you squared away. That's not really a stupid question. And I'll tell you a true story, Bradley. I've got one right now that per the county, per the assessor, it shows up as SFR, but the client of mine put an ADU with 2 units on it. And so when the appraiser goes out, the appraiser is going to say, oh, it's a single family and it's got 2 units in the back, and they're going to call it a triplex. I'm almost certain of it. And so, even with the assessor's page and looking up those records, if they say one thing, the thing that matters to a lender is what the appraiser says. And there's some markets near me that just have some funky type of stuff. They've got one lot with a single family up front and a duplex in the back, or they've got weird stuff going on, right? And so the ultimate thing I get when I contact account executives and I say, hey, what do you guys think about this property? What are you guys going to call this thing? They always defer to what the appraiser puts in his appraisal report, his or her appraisal report, and in their notes. If they call it a 3-unit, well, it's a 3-unit. If they call it a single family plus an ADU, all right, single family. And it matters, right? Because pricing's different. Dorothy Jones. I do mortgages. I am a mortgage broker licensed only in California. And so I'm able to help people in California all day, every day. That's what I do. If you're outside of California, Dorothy, I've set up greatmortgagebroker.com. You fill this out. Greatmortgagebroker.com. Quick little 6-question name, what state you're in, what you're looking to do, email, phone number, things of that nature. Someone's going to reach out to you. In Theo's case, I might have to send him a swag basket or something for having to not get contacted for a day. Fill it out again, maybe, Theo. Have her fill it out again. If she doesn't get contacted, heads are going to roll. I promise you. So yeah, that's the link right there, Dorothy. If you're outside of California, if you're in California, Matt at mattthemortgageguy.com. Did I do one of those banners? I guess I didn't. Well, just know that it's Matt at mattthemortgageguy.com. What's up, George? How you doing? Gaming with George. What is a disclaimer deed? Sorry, I said you're not going to get less than 10%. Then I proceeded to say 15% on a duplex. And then if you're going to own or occupy, it's 20 on a 3 or a 4. So sorry for getting your hopes up face too much, but it's just those triplex and fourplex, they want you to have some skin in the game. Do you already have an FHA? Is that why you can't do FHA again? All right, Liberty, I'm going to be biased in this answer because I'm a mortgage broker, and yesterday was National Mortgage Brokers Day. There may be some mortgage brokers at the New York Stock Exchange on Wednesday ringing the bell in honor of National Mortgage Brokers Day. May or may not be. It's just a rumor I heard. But yeah, I was a direct lender, became a broker in 2018. As a broker, I get to take your specific scenario, your 704 credit score, your 3% down loan, the fact that you have this much in reserves, everything, and say, okay, this lender's got this to offer. This one has this to offer. I think we'll go here. It's going to be a faster process. It's going to be easier. It's going to be the best rate, the best mortgage insurance. And that's where I place your loan. You go to a credit union, you go to a bank, you go anywhere else, more restrictive, one option. And if you don't like it, sorry. And so I think a mortgage broker is almost always your best option. And I believed that. And that's why I made the switch. When I made the switch, I was kind of proven right, at least in my eyes. I mean, I'm not knocking other folks. There's great lenders that work at banks. There's great lenders that work at credit unions. There's great direct lenders. I happen to think that the mortgage broker is able to get the consumer the very best loan. especially when you compare us side by side with a bank. A bank is not the best place for a home loan. They're the best place for lots of other stuff, not home loans. Credit unions, some credit unions do pretty good. The only problem with the credit unions, at least in California, is, truth be told, they offer some pretty decent terms. Their rates and their mortgage insurance are competitive, pretty close to that which you can get with a broker. But I just don't think that they have the systems in place to close loans as fast as we do. They're, got a little bit of the kind of the bank corporate side where it's kind of clunky and outdated systems and processes versus brokers that are just innovating and, entrepreneurs that have built systems like me and my team have. That's all we do all day, every day is mortgages. We're not worried about opening checking accounts. We're not worried about car loans. We're not worried about, setting you up with the financial advisor guy for some deposits. Like all we do is mortgages all day, every day, day. So mortgage broker, final answer. 720 in March. Didn't find a house. I'm still house shopping. Should I rerun credit? Yeah, I think you want to freshen up that pre-approval. I think whoever you're pre-approved with, I would contact them and say, is there anything you need from me to freshen up my pre-approval? Especially if anything's changed on your credit profile, if anything's changed with your job and how you get paid, if anything's changed in any way, you want to make sure that you're fully pre-approved and ready to roll. Worst case scenario, you find a house, you get in a contract, and then you tell your lender, oh yeah, well, I used to be 100% salary, and since July, I went to less salary, but I get commission, and with this commission, I'm making more money. Well, if we don't have a 2-year history of it, we can't use it. And so, long-winded way of saying get the pre-approval freshened up is my advice, especially if anything has changed. If you're like, listen, I've made $4,722 a month for the last 3 years. That's not changed. I haven't taken out any new lines of credit. I haven't done anything else. Then, you not necessarily going to be at risk of not being approved anymore. But I don't know. Whenever anyone's in that fully pre-approved stage with us, I'm proactively reaching out to say, what's changed? Can we spruce up that pre-approval? If you're like, hey, I'm holding off, I'm not looking for the next 3 to 6 months, all good. But if you are actively looking, have that pre-approval updated. Zeta, thank you for all your support. I appreciate you. He turned 66, got in from dinner. Happy birthday to your husband. Glad you guys got in a nice dinner. More inventory is going to the market. I see it. You see it. Hundreds of people in my comment section see it. I don't necessarily see prices falling though, Zeta. And that's the thing that I think people are hopeful that we see more stuff coming on the market, and that's going to mean a decrease in prices. We've still got a ways to go to even out supply versus demand, where we could have supply double and there's still enough demand to satiate. Is that a word? Man, sometimes I just pull some big words out of there. Enough demand to satiate that increased supply, that double supply, and still not have it be too much supply where buyers are just like, oh, I can pick from all these places. And they're, going from 15 to 20 offers to 3, and from 10 to 15% above ask to at asking or slightly above asking is a win for buyers. I don't think that like 5-10% decrease in prices is anything you'll see anytime soon. Just my opinion. I think what you will see is some sellers and some of their agents who don't have their finger on the pulse, and they see stuff that sold in their neighborhood where it might have been listed at 600 in March. There's nothing on the market. Somebody bid it to 680. That thing sold for 680. So now they're like, oh shoot, we're going to sell it for 700 now. They're going to list at 700. It's going to sit. It's just not as competitive in most markets as it was back in March and April. And when I say competitive, I mean like a lot of demand and very little supply. There's more supply, so it's less competitive, right? Some buyers took the summer off. Some buyers, backed out. Buyer fatigue, whatever you want to call it. The frenzy buying is over. That's my call. That's what I'm sticking to that. The frenzy buyer is mostly flushed out of the market. Now we got buyers like, yeah, I want to buy. I'm not going to go crazy. I'm already seeing it in some of my offers. Offers are getting accepted without waiving the appraisal, which seems like a crazy thing versus 3 months ago. Like, you didn't waive the appraisal? How the heck did you get something accepted? So another long-winded answer, but I don't see prices coming down. I see them flattening out. Let's call it a return to normal. Good evening, Cali Boss. Thanks for joining. With Congress approving billions of dollars to people behind on rent, do you see a market correction taking longer than originally anticipated? I'm not sure where I see the connection between those billions going to people behind on rent to, okay. So maybe I think I'm following. Maybe you're saying like this is going to like where some investors might have sold or where more stuff might have got liquidated or more evictions might have happened. Now it's going to like calm that. And so correction takes longer than anticipated. I mean, I don't see a huge correction. I see like a couple years of flattening, return to normal, that kind of stuff. And as far as this goes, people that are behind on rent, the 50 billion or whatever it is that's going to be distributed to get people caught up, I'm still freaking waiting. Like, they're so slow on getting that stuff to landlords. I've got a tenant who's been great, been working with them, applied for this back in like March, I feel like. It's been 4 freaking months. I want to get that tenant caught up. Not just for me, for them, so they don't owe any back rent. It's a burden off their back. So, yeah. If there's any correction out there, it's going to take years and years regardless. But I see it as more of like a flattening, a normal. I wouldn't be surprised if we saw like 3 to 5% appreciation in 22 and 23. It would be healthy. All right, Dorothy, shoot me an email, matt@mattthemortgageguy.com, and we'll see how we can help you with that loan over at Loan Depot. Get those folks working on you or help you out. I can only hope rates stay low, but I agree with you. If they stay under 3.5, it's still good. Yep, you're exactly right. I actually was thinking about my first purchase in October of 06. Somebody's stat that I looked at was like, that's where the highest prices were by some metric, was October of 06 when I bought my first house. And I bought it 6.25% first and a 12% second. And I don't regret it. And that's why when people are upset, like, oh my gosh, I don't know, like, I don't want to overpay for a property because I'm just not sure. What if this happens or what if that happens? My 6.25% was an adjustable rate. My 12% was an adjustable rate. That was the worst mortgage in the world. And I bought at the very top. And guess where I sit today, 15 years later? 6 figures in equity, great tenant that pays more than my mortgage, and a property in California that continues to appreciate. And so, yeah, I mean, real estate, if you're buying it for the long term, and as important, you've got it in 30-year fixed financing that's safe and not risky, you're in good shape. So yeah, I like, that's a glass half full, and I appreciate that. All right. Hello, Jessica. Thanks for joining. Closing on your first 2 properties. Congrats. That's exciting. Closing costs are higher than expected. Well, what did you expect? That might be where things went south, right, is closing costs are going to vary state by state, lender by lender, market by market, but you should have different sections. Some of those closing costs are going to be lender. Some of those closing costs are going to be the title company. Some of those closing costs are going to be prepaying your taxes and your insurance. And depending on where those were higher than expected, there's either something that can be done about it or something that not. You can't really negotiate closing costs. If somebody tells you can, they're a great bullshitter. You can take a higher interest rate and get a credit from the lender to offset those closing costs, but then you're going to pay more on your monthly mortgage payment. But as to like what parts of the closing costs are negotiable, the title fees, the title company has to get paid. So they're not going to negotiate. When you set up your escrow accounts to pay your tax and insurance, depending on what month you land in, there's going to be, a 12-month homeowner's insurance policy due. You pay that. And then you got to cushion the escrow account with 2 or 3 months of reserves on that escrow account. Got to pay that. Might be a 6-month installment of property taxes plus a couple months of reserves on that. And so a lot of times people look at that and they go, oh my gosh, the closing costs are so expensive. And then when you look at it, look at box A of your closing disclosure, lender fees. If that's only $1,000, okay, the lender's fees were $1,000 total, no big deal. Title fees, okay, that box totaled $1,322. Not too bad, $1,300. Then you get down in those boxes that are on page 2 that are the prepaids and the the escrow stuff. If that's $4,200, you're like, man, I didn't expect to pay that much. It's stuff that you're going to pay whether you pay it through the mortgage when you close or whether you pay it after and you pay it directly to the county for your taxes and you pay it directly to the homeowners insurance company. It's something that's got to get paid. So that's something to look at, is where are those costs more than you anticipated. And don't let somebody talk you in circles when it comes to closing costs, because I can tell you with absolute certainty, it's like, here's your closing costs, with all that stuff included, $6,100 and a 2.625 interest rate. Or we'll give you 2.875 and $3,900 in costs. Or we'll give you 3.125 and only $1,200 in costs. You're going to pay it one way or another. Either a higher interest rate and less costs, lower interest rate and more costs. Because title companies don't work for free, lenders don't work for free. They sure as heck do not pay your tax and your insurance for you. So straightforward answer. I hope I wasn't rude about it, but it's that's what you gotta look at. Where are those costs more than look in box A. Look in the lender box. If that lender box has more than a couple thousand in it, then you probably didn't use a mortgage broker, and that's might have been where you tripped up. Face too much. Just trying to avoid the MIP, but it is what it is. No worries. I mean, you just want a 5% down loan with no mortgage insurance to buy a forward unit that's going to kick off $2,000 a month. You're not asking for too much. So yeah, I get it. But yeah, the PMI is the cost of doing business. Here's how you should look at it though. If you're going to buy a 3 or 4 unit and you can use FHA, those rates are the same as the FHA single family, smoking rates. So don't think of it as like, man, I'm paying 0.85 in mortgage insurance. At least I wouldn't. If I was you, I would look at it as I can get a 2.5% interest rate, or it might even be lower. 0.85, just add that on, act like it's interest. Act like, you know what, I'm paying 3.375 and I was able to get into a 4 unit with 3.5% down. Then you'll feel better about it. And then 3 to 5 years from now, refinance into conventional, get the mortgage insurance removed, cash flow even more. You want to get pre-approved? All right, I got you. If you go to mattthemortgageguy.com, I don't send people directly to the site that often, but you can just go there and there's just an apply now. And just click that baby and get rolling. Or you could shoot me an email, Matt, M-A-T-T, at mattthemortgageguy.com. And We get you started that way. Let me see. See how this website's looking. Copy. Dun, dun, dun. I'm going to paste this just in case. Matt, see how there's 3 T's there? Because it's mattthemortgageguy.com. Go there, and there should be, let me see, what is there? Apply now. Here, why don't we do this? All right, hopefully you guys can see this. mathmortgageguy.com. There's an apply right here. There's an apply now right here. Boom. Piece of cake. This is the Flowify application. You fill out your email. You set up an account. Application gets done. Thanks for entrusting us with your loan. Sends you a follow-up where you upload your docs securely, and you're off and running. So that's how you do that there. All right. How does RSU stock or sign-on bonus being calculated towards income? I got good news for you because I'm in California with a bunch of Amazon employees, a bunch of Google employees, a bunch of Facebook employees. So if anybody doesn't know what RSU, restricted stock units, a lot of tech companies will pay their employees $150,000 in salary, $90,000 in restricted stock units. Good news is in most cases, we can use that. We treat it like bonus income where we want you to have it for 2 years. So we can take an average. If you've had that job for more than 2 years and we see in 2019, this was your base, this was your RSU. 2020, this was your base, this is your RSU. 2021, and we just take an average of it just like we would with bonus income. And so really they're equal. The sign-on bonus, not so much because it's a one-time thing. And that kind of is a rule of thumb that you can think about in lending, that if it's not something that's reoccurring every year, we're not going to use it as income. And it makes sense, right? Something that lenders try to do is guesstimate what you're going to make in the future based on what you made in the past. Well, if you made salary plus bonus plus commission, whatever, what you made in the past is probably a good reflection of what you're going to make in the future, so we can take an average. If it's sign-on bonus, you're not going to get that every single year, so we wouldn't use it. Oh, here we go. Somebody's had to say it. Hit the like button, please. Where are we at? 23? We could do better than that. We got 60 plus people watching. One of these days, we are going to hit 100 people watching concurrently. You guys think it's going to be in August or September where we get up to 100 people watching at once? I think we're going to do it in August. I got faith in us. I got faith in you guys coming back every single week, asking me good questions that are so good. People keep coming back. There we go, Caden. Get in there. We're going to hit 50 pretty soon here. Then the YouTube algorithm is going to tell people, come join. There's 60 plus people watching on here. This guy's got something interesting to say. I'm in a hotel room, but for you, Caden, I do not miss a YouTube live. No matter where I'm at, I'm with you, bud. All right, my husband and I had an eBay business that brings in $2,000 plus a month. It can count towards your income, but here's the thing: how do you claim it on your taxes? Because bringing in $2,000 a month and showing $2,000 a month in income are very different things. If it's just filed on like a Schedule C on your tax return, then you're going to have a top line, and if it's $2,000 a month in top line, meaning that's like the revenue you generated, and that's $24,000. If you wrote off expenses and then your bottom line net income says $1,400. The $1,400 is what we're going to use for income. Divide that by 12, and we'll only be able to add that, $120 a month. And that's the issue with a lot of self-employed income, is we can only use what hits the taxes. And trust me, I've got people that have hundreds of thousands of dollars per month. I'll use a liquor store as an example. $2.5 million top line. If only 40,000 hits the bottom line after they write off everything that they can write off in that business legally, they're legal write-offs, then we can only use the bottom line, the net income. Whether it's on a Schedule C, whether it's an S Corp, no matter how it's structured, whatever hits the bottom line on your tax return is what we can use. And so that's where self-employed borrowers run into issues. Is they're great business owners, they make great money, they also hire great accountants, and those accountants be saving them some money. Eddie, true. I'm going to tell you, this is the straight answer. It's the easy answer. Don't do it. I think Caliber has a 5% down jumbo program. It is absolute trash. God, I'm screaming in a hotel room, and it's late, 10 o'clock. I would do 10% down. I've got a 10% program. It's under 3% with no mortgage insurance. No, take it back. Not under 3% with no mortgage insurance. I was thinking about the 20% down. 10% down, though, I bet you're in the low threes, no mortgage insurance. And that's what you want to do. I bet you that the 5% down jumbo is like in the fours. And I can tell you that if you're having a loan amount that's $800,000 and you've got a high interest rate, that's going to be not so nice. So, I'm just pricing it just out of my own curiosity now. If you bought for like 1.1 milli, you put 10% down. Because this program is amazing. You get to not only put 10% down on jumbo, but you get to go no mortgage insurance. Yeah, it's in the mid threes with 10% down. I bet you it's at least mid fours. And I mean, 1% on a $900,000 loan is over $500 a month. It's a lot. So don't do it. Put together 5% more. Yeah, Miss Taylor, let them know. Smash the like button. Let's see. Let's check in again. Oh, we got a thumbs down. Oh man. I don't know if I've got any thumbs down on the lives yet. Well, it's a first for everything. Pro cons. There's definitely 80-10-10 loans. And anybody who's wondering what the 80-10-10 is, 80% is the first mortgage, 10% is the second mortgage, and then the buyer puts 10% down. These were pretty popular in that jumbo space because there wasn't really a lot of lenders that were doing 10% down jumbo. And so you would put an 80% first, where that lender in the first position just does a standard loan, just treats it like it's a 20% down. But then there's a 10% second. And this lender is a gamblero, willing to sit in second position and do a 10% down. That second's usually like an adjustable rate. Terms aren't fantastic, but it allows you to get into a jumbo loan with 10% down. Rather than do that, I think this new product, 10% down, that's a nationwide product with United Wholesale Mortgage, is the way to do it. If you're putting 10% down on a jumbo, you don't have to bother with a second loan. You don't have to bother with anything else. Yep. Sure enough. I do these all day, every day. And if you're not in California, fill out the form, and the lending partners I have all across the U.S. also broker these loans to UWM, and it's prime jumbo. It's their specific product. I made a video on it. I think if you search my channel, 10% Down Jumbo, you'll get information on it. It's a great program because if you bought let's say you're in a high balance county in California and you bought $900,000 with 10% down, you'd have a sub 3% rate, but you'd pay a lot in mortgage insurance. This loan, your $1 million loan, you're buying for 1.1 or so. Rate might be 3.375 or 3.5, and you're putting 10% down and paying no mortgage insurance. So it's a good looking loan, and it's an easy one to get. The underwriting is fairly straightforward. What's going on with federally backed forbearance? Well, they're working with borrowers as you're coming out of forbearance. You're being offered all kinds of different modification stuff. And so, we're slowly but surely having everybody exit forbearance, and they're exiting forbearance, and they're performing. All the data that's come out from Black Knight just shows that people are coming out of forbearance. They're refinancing, or they're modifying, or they're just hopping back in and paying their loan because they took it as a precautionary thing and didn't really have an issue. So that's what's going on with it. And it's ending soon, at least ending people being able to enter into it. Oh man, I got you, Manny. No problem, dude. Happy to help. Yeah, see, people are not only not hitting the like button, they're hitting the down button. And I got to say, man, that hurts my feelings. That one down arrow. Maybe it was a misclick. Or maybe people are just not feeling me tonight. I don't know. I woke up at 2:40 a.m. So I'm tired. Maybe it's not the usual Math and Mortgage Guy energy. So it's the thumbs down. I'll take that as constructive criticism. You guessed it, brother. You guessed it. See that? That should be a familiar building for some people. That's One World Trade. Walked over there and saw the memorial today. It's pretty cool. Max rate lock, Benti. This is like a trick question, because when you say max free rate lock, I don't know if I would consider it free, because you've got like 15-day locks, 30-day locks, 45-day locks, 60 locks. They all have a different price associated with them. It's just that the farther you are out, the more expensive they become. And let's just, for example purposes, say if you lock today on a 30-day lock, 2.625 was zero cost. Then if you locked on a 45, 2.625 was a quarter point cost. And then a 60-day was a half a point cost. And a 90-day was a full point for that same 2.75. It's not that the 30-day is free. It's just less than the 45, because maybe the 15-day is that same rate, a little bit of credit. So I think that answers your question, right? The shorter the lock, the cheaper it is. And it's just going to be, you know what I did the other day? I pulled up this. Different lenders I work with have different price sheets. I'll show you guys what home points look like, because it's pretty snazzy, and it shows you all the 15, 30, 45, 60. Quick pricer. And let me see. I'm just going to do a quick little purchase. Quick little 400 grand with 25% down. It was already pre-populated, so that's what you're getting. All right, so boom and boom. Here is 2.75% on this purchase. If you do a 15-day lock, you get an $1,800 credit. If you do a 30-day lock, it's only a $1,400 credit. If you do a 45-day lock, it's $1,672, then $198 cost, and then you do a 90-day and you pay $938 for it. So it gets more expensive the farther you go. There's no quote unquote like free. You know, if you go to 2.625, then it costs $567 on a 15-day, $984 on a 30-day, $1,410 on a 45-day. Hopefully this helped. It's kind of cool to look at. Get to see the whole rate sheet and get to see all the different prices for the different number of days on the lock. Man, rates are good. Rates are real good. You guys got to go check out my boy, Mark McDonough. If you're interested in California real estate at all, this guy just crushes the content on Sacramento real estate all day, every day. Guy's a machine. Does HELOC affect the loan to value in refinancing? And do I get a higher interest rate just because I have a HELOC, even though I have zero balance on it? Yes, and yes. This is a common problem. BOJIM. What the lender's going to do, because, okay, your home's worth $500,000. Your first, you only owe $300,000, but you have a $100,000 home equity line opened, even though you're not using it. You got zero balance on it. The lender is going to look at your CLTV, combined loan to value, and they're going to base your pricing. Let's say you do a rate and term refinance on that $300,000. They're going to do, the pricing is going to be based on 80% loan to value, because your first of 300 plus your 100,000 that's available in the HELOC add up to 400, and your home is worth 500,000. So in the lender's eyes, 80% loan to value. And you can see why that makes sense, because if you close that loan and then go rack up 100 grand on that HELOC, you've got 80% in debt versus that $500,000 value. So you got a couple choices. You can take the higher rate and like it, or you can close that HELOC. Really up to you. Yeah, that's how lenders look at it. And it depends, you know, in that scenario where I just mentioned, where it's like 60% LTV or 80%, world of difference price-wise. A lot of buyers I work with, their house is worth $900,000. They've got a $250,000 loan and they've got a $100,000 HELOC. It's not going to affect them because it's going to be under 60% loan to value with or without that HELOC. And so in that case, it wouldn't matter. But in the example I showed, between 60% and 80% loan to value, world of difference when it comes to the terms. Good question, man. Thanks for asking. Johnny Stash. I took my house off the market a month ago. Should I relist my home before putting in new offers, or should I list first, then put in offers to buy? Both of your things were listing first, which is the right answer. So it's, should I list or should I list? And yes, you should list, because one, the contingent buyer, although you're making a comeback and you have a chance of getting your offer accepted as more inventory comes on and as it gets less competitive, it's still, you're at a little bit of a disadvantage. You've got to sell to the seller. Hey, listen, I want to buy your house. As soon as my house sells, I'm going to take, and if my house sells, then I'm going to take that money, I'm going to buy your house. You should be listed. And then in a perfect world, you have an offer accepted on your house. And you can always have your offer be contingent on you finding a replacement property, but you're going to have a lot easier time getting in contract moving forward if you have an accepted offer on your house. That's going to give the seller a lot more warm and fuzzies than, I want to buy your house, but when I sell my house. I listed it a month ago. It didn't sell, but this time it's gonna, because I want it to, and I want to buy your house. Just think about how that plays out in the seller's head, where they've got your offer, they got someone else's, even if someone else is lower, $5,000 lower, but they don't have to sell a house. It's gonna make your offer stand out in a bad way. So list it for sure. Work on getting it into contract if you've identified something you want to buy forward, and then write aggressively, have your lender reach out, have your agent schmooze and sweet talk, whatever you got to do. Good luck to you. Hey, what's up, Brian? Can I use money from positive equity to pay closing costs on a refi? Absolutely. 9 times out of 10, 97.6 times out of 10, 97.6 times out of 100. That's how the refinance would work, is lender, title, prepaying escrows, all that stuff rolls into the new loan. And so it's just paying off your old loan, rolling in the costs. New loan amount's going to be slightly higher, but it's rolling in. It's not coming out of your pocket. It's just basically coming from that equity, right? Because it's paying off a loan of 298, new loan of 304. So you've got less equity in the house because your house is worth 500, but you've got a slightly higher loan amount. For people, they're like, oh my gosh, I don't want to roll in the prepaid escrows. I don't want to roll in the closing costs, and I don't want to roll in the lender fees. You're going to skip a payment. You're going to get a refund of whatever's sitting in your current escrow account over there. So take that $3,500, that $4,500, and apply it towards the mortgage if you're really, opposed to having a higher loan amount after you refinance, because it is a little bit of shuffling of money. And if you don't mind it going up a little bit, you're going to get a little bit of cash influx. So you're going to miss a mortgage payment. That $2,000 isn't going out. You're also going to get a refund of what's sitting in your escrow account. The escrow account that pays your tax and insurance, your current lender's holding it. When that loan gets paid off, within 30 days, they have to refund you that full amount. And so you're going to get a check in the mail, $3,200. You're like, cool. Is this the money for my tax and insurance? Do I need to send this to anybody? No, we set it up with your new mortgage. When we paid that stuff through close of your new mortgage, when we refinanced you and paid that stuff in advance, that's where that money came from. Sabino, see? Somebody appreciates what I'm doing out here. You definitely didn't give me the thumbs down. I appreciate the kind words. Let's see. We're 42 likes. We're 1 dislike. So, I mean, we're still batting pretty good. No problem, Jazz. I got your back. Thanks for joining. How can you shop for a mortgage if lenders refuse to give you a loan estimate form? Well, if you give a lender your mortgage statement and a guesstimate of your credit score, and they won't give you a ballpark idea of what kind of loan they can offer, they're probably not competitive. Because I'm almost always willing and able to offer that to somebody. And if somebody's holding back from giving you some sort of estimate, then maybe they're not super competitive. Or what can also be a function of a market like this, where it's just so busy everywhere, Jermaine, is that lenders are really busy, and they don't necessarily want or need to deal with like people who are shopping or seem like they might not be that likely to close a loan with them. And that's just my honest feedback for you is lenders are busy. They're in a great position where they got so much business, they can hardly stand it. And so maybe they're like, you know what, dude, like, no, unless you fill out an application, get us all your docs, like, we're not going to show you a loan estimate. Whether that's right or wrong, so be it. I'm sending out estimate after estimate after estimate. I probably do 80 of them a month without, doing the full kit and caboodle. I'm just asking somebody for their mortgage statement and the estimate of their credit score and what they're trying to do. And with those things, I can generate a pretty accurate loan estimate that says, here's what we can do for you. If somebody's not doing it, they're either busy or they're not competitive. That's my 2 guesses, 2 answers. I'm sticking to it. What is the DTI limit for a 10% down jumbo loan? No, it's, what's up? Sacramento, man, hit me up. They're doing those 10% down jumbos at, I think, 36.45. Man, you caught me off guard, dude. Let me see. If we go to my jumbo, I'm searching in my channel right now, 10% down jumbo loans. Because I'm going to, yeah, it's 45. Maximum DTI 45. Here's what we'll do. We will go copy and paste. Boom. Now, that should be in there where you guys can click on that. This is the link to a jumbo video I did. What did I call it? Jumbo loan is back. Oh, maybe that was, I got a couple different videos. There's two different. Type jumbo loans into like the search on my channel. There's that one and another one where I talk about them. 45% max. Make sure you hit me up. I'm happy to help you. Narayan. Is that how you pronounce it? It reminded me of Nayarit. Is a nice little place in Mexico where when I was studying down in Mexico, I used to go down to the beach in Chacala, Nayarit. Beautiful state in Mexico. This is a good question, Del J. And another opportunity for me to do this. Okay, 3% down conventional. You can put down 3% and you can buy a house and you could pay no mortgage insurance, but it might not make a lot of sense to do it that way, because what happens when you put down less than 20% and you don't have mortgage insurance is you pay for it with a higher interest rate. And that's like anywhere you see advertised, no mortgage insurance. We do 3% down, 5% down, no mortgage insurance. Of course they do, because they charge you a higher interest rate. So, here's 3% down. This is hard to read, but let me try. And there. So see here, conforming conventional 30-year fixed monthly. So you're putting 3% down, you're getting a 2.83 rate and $116 a month in mortgage insurance. Your total payment $17.18. Or lender paid mortgage insurance. You don't pay any mortgage insurance, zero, but you have a 3.38 interest rate. So look at the payment. The payment's like exactly the same. But here's the problem. You get in a position where you could remove mortgage insurance. This payment goes down by $116 because you remove it. This one you can't remove. I mean, you got nothing to remove. So you're stuck with this 3.38 interest rate. All day, every day, and twice on Sundays, I'm having you do this one. Pay the monthly mortgage insurance. The beautiful thing about conventional is you can apply to have it removed. After a couple of years, you got some equity. But, to stick with this higher rate just to say, hey, I did this and I didn't pay any mortgage insurance, probably not what I would recommend. Here's the whole rate sheet. So a strategy you could also employ is, hey, I want the low rate. I don't want to pay mortgage insurance, but look at that. Look at like 2.875 is like a $6,000 cost. That's you like buying out of the mortgage insurance. I wouldn't do that either. I'd pay that $116 for 2 years. And what's that? $2,500-ish. And then have it taken off. Maybe you pay it for 3 years, $37. I mean, you're not going to pay it for as many years as it's going to take for this $6,000. So yeah. Basically me saying, I don't think you want a loan with less than 20% down with no mortgage insurance, unless, you put down 10 or 15%, that equation might change. And you can look at it. I'd be happy to, if it was a California deal. If you're outside California, connect with one of my trusted partners. They'll help you out. It depends on the loan. The specific loan I'm talking about with the lender where I send my jumbo stuff to, on the 10% down ones. United Wholesale Mortgage, UWM, they got their own program where it's a portfolio loan of theirs. They're only going to require like 3 to 6. Some lenders might want 12, but depending on credit profile, how many properties you own, different things like that, 3 to 6 on most of those 10% down ones. If you put 20% or so, you might find lenders that don't need any reserves, but it all depends. I would say 12 is probably on the high end of what you'll see. 3 to 6 is on the low end. Everyone, please take a moment and like the videos. Matt is donating his time for you. P.S. Who is the jack with the thumb down? I appreciate you, Merrick. I really do. And I enjoy the heck out of doing this. And if we have, 59 thumbs up and 1 thumbs down, I'll be okay. I won't cry myself to sleep tonight. But you're right. 2 hours of my time every single Monday. I really enjoy helping people out, even though it is a time commitment from me. You are correct. We're up to 49 likes. So people are showing the love. Is it ever a good idea to do a cash out refinance? I think so. I mean, I know a guy with 2 thumbs who did a cash out refinance or 2 of his personal stuff. So yeah, I mean, I know investors who are really, what's the right word? They don't want to have a bunch of equity in their investment properties. It's a liability. You own a property that's worth $600,000 and you owe $125 on it. Some investors see that as a $500,000 target on your back. Go out and sue you. They'd rather lever that thing up to $450,000, have that money, at 3% interest to go out and deploy elsewhere. So I think my best piece of advice for is it a good idea to cash out refinance is depending on where the money is going to be deployed. If it's going to be deployed on a business that's going to provide you a 30% return, if it's going to be deployed on an investment property that's going to have a 20% return, if it's going to be deployed to pay off 18% credit card debt, all those are great reasons. If you're going to buy a boat or if you're going to go on an extravagant cruise that's going to cost you $60,000 and you want to pay it over 30 years, some of those things, no. If it's going to be put to good use, then yes. And I mean, a lot of the things I'm seeing right now where I think it just makes a lot of sense is people who are in high interest debt. And I'm not talking about $4,000 in debt. I'm talking about $52,000 in credit card debt where they're swapping between card and this card and they're doggy paddling upstream. Wipe all that stuff out. Have one mortgage at 3%. The people that are going from 3.75 down to 3, they're paying off $50,000 in credit card debt. Their payment hardly moves. And they've got all this credit card debt wiped out. If you're thinking to yourself, I don't want to owe more on my house, that's going backwards. Okay, take the $1,400 a month you're paying towards those credit cards where you're just treading water, apply that to your mortgage. Your mortgage probably pays off in 12 years, right? So those are the situations where it makes a lot of sense. I made a video, pros and cons of a cash out refinance. It's a pretty good one. My original one that I made 3 or 4 years ago has 100,000 views. I made a new one because that one was so popular. The new one is on its way to getting tens of thousands of views because it's a really good question. And I try to do it justice by answering it. So go into my channel, search pros and cons of a cash out refinance. You should come out with 2 videos. Watch them in any order you want, but you got to watch them both and watch the whole thing for the YouTube algorithm. Do not only watch the first 4 minutes and turn it off. YouTube will shut me down. Just kidding. Joey Garesi, thanks for the B of A information, by the way. I appreciate it. People are asking me about the B of A down payment assistance program. And Joey was kind enough to send me some information. I got it. I appreciate you, dude. I'm going to get to it. It's on my list of 950,000 things to do, along with recording the final videos for my YouTube course. which I still haven't thought about. And this is something, let me poll the audience. I'm creating a course, and part of me is that mindset of like, come on, bro, like you provide all this free information. Why in the heck would you create a course where you're going to charge people? I know, because I've been a purchaser of courses. Chandler David Smith has an investment one. Ryan Pineda has one. Meet Kevin, Graham Stephan, all these courses I've bought, whether it's on real estate investing or whether it's on, business type stuff. And I know that when you spend money, you're more apt to like dig in and really spend the time and energy to digest it. And so my thought is that I sell the course for some ridiculously low price. If I had it for 97 or 147, but then I discounted it by 50 or 60%, and the price was 40, 50 bucks, easily a mortgage course saves you thousands on your first transaction. And if you do more than one mortgage transaction, you're going to save 5 figures just knowing some of the information that I put in there. And so this is my poll to audience question, is what is a fair price? I'm almost certainly going to do a big discount to anybody who's in California, because then they're an actual client that may be a future client of mine. Probably give it to anybody who's pre-approved with me or working with us. So it's probably free for a client of mine. It's probably heavily discounted for California. And then it's probably relatively inexpensive for the rest of the country. But throw some numbers out there. 0 could be a number, 47, 97, 147, 88, 128. Let me know. All right, Brian Redford, how would you rate United Wholesale Mortgage Company? The very best. It's no secret. If you talk to any mortgage broker out there, well, 90% of mortgage brokers, they're going to tell you that United Wholesale Mortgage, who did $182 billion in home loans last year, did $182 billion, way more than anybody else in the wholesale lending space, because they're the best of the best. Technology is the best. Customer service and speed are the best. Their partnership with brokers like myself, who send them thousands of loans, the best. So that's what I think about it. And I know that some people ask me, I have clients that ask me, hey, I saw some negative reviews online. Should I be worried? No, because the steakhouse that has 80 locations and 400,000 people that visit every year is going to have more negative reviews than the one location steakhouse that only has 2,000 people go through their restaurant every year. You know what I'm saying? If you've got 200x the volume of somebody else, you're going to have more negative reviews. That steakhouse that only does 2,000 people a year only has 4 negative reviews. Great, right? The steakhouse that is a chain and it has 400,000 people through their doors every year, they've got 92 bad reviews. But in proportion to how much business they do it better. Made that up on the spot. Kind of like that. You are right, Joey. Man, I got to stretch, bro. I got to stretch because a lot of refinance can be done in the next few months for sure. Refinance rates are smoking. People who are thinking about refinancing and don't do it. You know what I have currently on my phone right now is that meme, that GIF, help me help you. So I got people like, oh, sorry, man, I've been busy. Was just checking in. And I just send them that meme. Help me help you. They've got a 4.25 and they're paying mortgage insurance, literally lighting $10 bills on fire every single day. That's what people who are paying $300 more for their mortgage per month than they should. They're lighting a $10 bill on fire every day. Forget losing to inflation. Lose to your own inability to get together a few docs and application to do a refinance. Don't do that to your family, people. I mean, it's so easy. And I use the analogy all the time because I know people will spend hours with DirecTV. They will cut coupons. They will do anything they can to save $10. You offer them $300 a month savings on a mortgage. You're like, I don't know. I'm pretty busy this week. I'm working 37 hours. Don't know if I'm gonna have time to do that application. That's 10 minutes. And uploading those docs, that's another 14 minutes. I don't know if I have that kind of time. $3,500 a year in savings, but you ain't got time. All right. Enough rant. When you say lenders, not all lenders, and that's the beauty about being a broker, right? Because I've got lenders who were doing 580 FHA through the pandemic and 740 conventional. No way. What is this, like Chase? Maybe this is Chase. Maybe this is a bank or something. But if I was only doing loans for 640 and higher FHA and 740 higher conventional, I would have put my my close for business sign up or something. For sure. Most lenders have lifted almost all overlays. Lenders I work with were never this strict. We're never 740 conventional strict. That's straight bananas. Oh, that's what I'm talking about, Zeta. Oh, I definitely got trolls. Trolls that are looking for boogers in my nose. Trolls that are... I had a funny comment today, though. Somebody told me I'm an idiot, but it was just like a joking thing because I said I'm either a genius or an idiot. But yeah. I don't really let it bother me, but I think you're right. I should start looking for that as a sign that I'm doing something right and I'm on the come up. Thank you, Zeta. Appreciate you. The Mortgage 101 course is going to be for buyers. But to your point, Miss Taylor, I had somebody tell me that I should make one for people who are looking to get in the mortgage industry, which is probably super, super needed because I know that I get, as much as I get mortgage questions and guideline questions, I get a shit ton of what would you do if you were brand new? What would you do in the first 6 months? What's the most important thing to do the first 3 months? And I really enjoy helping those folks because I know how tough it was, but how worth it was as a new mortgage broker 7 years ago. It seems like lifetimes ago. So yeah, this one is going to be for home buyers. Oh, Mortgage 101 Home Buyer Edition. Mortgage 101 Mortgage Broker Edition. That's what I should do. Thank you. Thank you. I'm telling you, I see this. I see your comment 10 times, and then I see the comment of like, not here yet. No, we're super hot. Things are going way high above list. And so I think this is the more common answer. More stuff's coming in the market, stuff that's coming on to stay a little bit longer. Sellers, they just don't know yet. They're listing it like it's March and April, trying to get 10% more than their neighbor sold for in May, when really they should be pricing it at or below where their neighbor sold. All right. I got you. Get that refinance rolling. Are you with me in California or are you somewhere else? Either way, good stuff, man. Refinance rates are smoking. I went to 3 and they all do the same thing. It's just a form. Oh, when you said you're trying to shop lenders and you're trying to get a refinance quote, I mean, don't do it online. Here's my advice to you. No matter where you're at, let's say you're in Plano, Texas. Find maybe your credit union that you bank with and say, hey, here's what I'm trying to do, refinance. And I've got a 724 credit score. Have them give you a quote. Then Google Plano, Texas mortgage broker. Find a Plano, Texas mortgage broker, or use the greatmortgagebroker.com link and connect with them. Get 2, maybe 3, and maybe even talk to them and see if they're somebody who sounds like you can like and trust them and they're going to give you honest feedback. Because truth be told, what happens, and I put this in a video of mine, this is good advice for everybody listening, I think. The more you search for the lowest rate, the best price, and you're just like on a hunt for the best deal, you're likely to come across the biggest liar. And so you're going to be digging. And before you know it, it's going to be September and rates won't be the same. So talk to a couple people and look at it and go, okay, I'm in a 4% right now. This guy's saying 2.875. This guy's saying 2.75. The fees look about the same. The guy at the 2.75 sounded like a nice guy. Sounds like somebody I could trust. I'm going to go with them. And then just go. Because you're going to find those two. Then you talk to a third one that says, oh, yeah, I could do 2.625. You talk to somebody else like, oh, yeah, I can do this deal. And you're either going to get somebody who's going to promise the world and they can't deliver, or you get somebody who shows you a fancy rate, a 2.5%, but they have $6,000 in costs just in the lender box or something to that effect. They're not going to necessarily give you the best mortgage. And so it can be daunting. There can be layers of, smoke and mirrors that you don't see. And before you know it, you're like, oh, sounded good, but why is there $14,000 in costs on this loan? 2.5%, 30-year fix. That's the best I found. Well, it wasn't the best you found because the 2.625 with 8,000 less in fees was way better than that 2.5 that had 14,000 in fees. Hopefully that helps. Inessa, thanks for joining. I have a house in New Jersey with around 175 to 200,000 equity. I want to buy a lakefront lot in Florida, $70K, and build a $270K home on it. Credit 700, income 30K. What's the best way to do it? So if it's just you on the loan and income's 30 grand, you're only working with $2,500 a month in income, I don't think it's going to be possible to do a cash out refinance of New Jersey and get a mortgage in Florida, because even if you could pull out the 70 grand and buy the lot outright, which is probably the best way to buy a lot because the financing on it is expensive and requires a big down payment anyway, you're going to have to qualify for some sort of construction loan to build. And just thinking about it in my head and being honest with you, whatever the mortgage is, let's say you only owe 100 and you pull out another 100. So you owe 200 on New Jersey. That payment plus a construction loan, not going to, $2,500 a month on the income side isn't going to be enough to support both of those, because lending is basically ability to repay. They're going to look at $2,500 a month in income, call the New Jersey one a $1,400 payment. They're not going to allow you to stack another $1,200, $1,400, $1,500 payment on top of that and have more mortgage payments than you have in monthly income. So I was going to make a bad joke. I'm sorry. You could find a rich husband or a rich wife or a cosigner with some more income, but just based on the information you gave me, I think it might be tough. Liberty Returns. I don't know. Rent has gone bananas in a lot of places. I can't remember the data I saw last, but rents had increased a lot. What do I think will happen in areas that rent hasn't risen as much as housing prices? I mean, some people might stay put. There might be less demand in those places. It'd be interesting to see what the home prices have. Well, we know the home prices have gone up, but I wonder if it's such a dramatic change, such a dramatic difference between rents barely creeping up and home prices going up this much that we start getting less buyers because less people can afford it and more people decide to rent instead of buy. And maybe that helps correct it a little bit. I think supply demand in that way will help even things out. Or else I would think it would. Jerry J, who has the cheapest closing costs for VA loans? Broker. This is a point of soreness for a lot of mortgage brokers because a lot of these big companies that literally advertise that they're like Veterans United or whoever the heck they are, have some of the highest costs VA loans. Because fun fact that not everybody knows, just because, well, every lender can set their margins however they want. And you could be a lender that's charging 3x as much to a veteran for a VA loan as a mortgage broker. And somehow that's legal and it happens. Find a local mortgage broker. Greatmortgagebroker.com. Notice some more people reducing home prices nowadays. Yeah, some of them are just unrealistic sellers that don't realize we've got more inventory. We got a few less buyers. You can't price it like you did in March and April. I'd be interested to know where in the country you are. Gone viral. All right. In this crazy changing market, number one recommendation for a new loan officer. Number one recommendation for a new loan officer is get better every single day. Do everything you can to be as knowledgeable as you can so you can advise well, so you can add value. Because the last thing somebody wants when they're making the biggest decision of their life is somebody who doesn't have anything to offer as far as value goes, right? I think when you're involved in a mortgage transaction or you're involved in the purchase of real estate, you want somebody on your side who makes you feel like I got you. And when I've got people who come to me and my team and they're getting a mortgage loan, it's a scary process. It can be, really for even folks that it's not their first time, even if it's their second or third time. You've got a full-time job, you've got kids, you've got things going on, you're buying a house, you're trying to get the documents into the mortgage broker, you're working overtime, you got 1,000 things going on. It can be stressful. And so I like to tell people, listen, I understand you got a lot of stuff going on, but don't worry. Me and my team do mortgage all day, every day. We got you. If we need anything from you, trust, we'll let you know. Check your email every day. You're going to be getting updates from my team. And we're going to lay out a roadmap that shows you initial disclosures, appraisal ordered, underwriting approval, appraisal back, conditions needed. And along the way, you're going to get those milestones checked off. You're going to get email updates. And trust me, you're going to hear from us if anything is needed on our end. That's the type of feeling you want to give somebody when they're working with you. And so do that with anyone you're working with. And for any prospective people who you're going to work with, talk about that. Talk about things you're doing to help serve in a way that isn't like salesy, right? So excited. I helped somebody get into a great VA loan and they only had to come out of pocket $3,200. So pumped on this latest refinance I did. I was able to save a family $375 a month, whatever that is, right? That's your advertising, is serving people at a high level, being excited about it. Because I'm telling you, like I shared 2 stories with my team today about past clients where we all cried. It's the most rewarding work you could ever do. You save somebody $900 a month and keep them in the house that they thought they were going to have to leave after going through a nasty divorce and being a single parent. It's life-changing. You help a 56-year-old veteran buy a house who didn't think he was ever going to be able to buy a house, and he's crying at the closing table. It's good, man. So yeah, that's my number one recommendation in any market. When I came in 2013, it was the taper tantrum. The Fed started raising interest rates and the market went bananas. I literally made a decision to become a mortgage broker, and then rates went up 1% in like 1 month. I think it was summer of 13 before I could even get my license. So it was volatile. It was tough. I just try to get better every day. All right, Jonathan, thanks for joining. Appreciate having you here. What is the most you can cash out refinance on a house? Most lenders, if this is your primary residence, are going to cap you at 80% loan to value. Some people mistake this for, I've got 200,000 in equity, I can get 80% of that out. That's not how you do the math. The math is your home is worth 500,000. 80% of that is 400,000. That is your max loan amount. So whether you owe 320 or 290 or 262, your max loan amount is 400,000, 80% of the value. If your home is worth 300,000, your max loan is 240. You just multiply your appraised value by 80%, and that's your max loan amount. I have some debt and want to refi. What is better, less debt or 100K in the bank? Depends on what kind of debt it is. If you have high interest credit card debt, high interest debt of any kind, I would pay that stuff off. I mean, you can put the money in your bank and it's going to earn 0.05%. That's not helping anybody. So more than likely, I mean, I'd say go for both. Pay off the debt and have a little bit of money in the bank. Final answer. I've been building a new home in Arizona with Builder, but my circumstances have changed. Have 3K down in earnest money closing in September. Should I try to sell for profit or lose earnest money? Can you transfer the contract? One, I would check and see if you could transfer the contract, which I don't think you always can. Two, builders are notoriously some of the worst at keeping earnest money deposits. So they've got contracts that just are not buyer friendly. And so they're going to, well, I'd see. First, I'd see if it's transferable, because I don't think you can sell it for a profit and be a middleman, transfer the contract. And if you can't, then maybe sweet talk your way into backing out and getting the earnest money deposit back, depending on how far along you are. And, you would think they can sell it for more. So they wouldn't sweat you for the 3K, but knowing what I know about builders, they'll sweat you for the 3K and they'll sell it for more. Looking for a good course and mentor for buy and hold investment properties. Any recommendations? Have you checked out Mike Zuber, One Rental at a Time? Go to One Rental at a Time on YouTube. The guy puts out 5 or 6 pieces of content every day. He wrote a book called One Rental at a Time. Fire me an email, Caden, matt@mattthemortgageguy.com. I'll send you a copy of his book, and I'd start with that. Really easy read. And at the end of the day, buy and hold investment properties, not a super complicated deal, but depending on what state you're in, I would probably create a relationship with a mortgage broker who is also an investor. And that way you can kind of get your ducks in a row with the lending side of it. And then action, man. Action. I wish I would have started sooner. Oh, my dude. Refi app with me. All right. I might be out of town for a few days. Hopefully my team is very responsive. So let me know or let the team know. If you send an email to matt@mattthemortgageguy.com, my team's on it. They're going to respond to you. And you could be like, sent my app in, what's going on? But the front end team who's dealing with the application and uploading the docs, they are going to reach out to you and say, thank you for submitting your application. Looks like you uploaded this, this, and this. We still need this, or something to that effect. we'll be in contact. Justin V. I better put a note here. I'll have to take a look at Justin V. Make sure he gets the red carpet treatment, the mink mittens. Oh, so you've got all that equity, but you're moving. All right, Inessa. So you don't need to find a sugar daddy. You just need to find a way to. My first question to you and anyone who's looking to build is why. I know in California, building is a nightmare. It's expensive. And so let's say you sold and you said you have 175 to 200 in equity. You bought the land, 70. Then you're able to put down, let's call it another 100 through a program where it's like construction to permanent. There's a lot of different lenders that offer that type of financing where it's a construction loan and they release certain amount of funds during the construction process. Then it turns into a 30-year fixed conventional. That's why it's called construction to permanent. All right, that's doable. I guess follow-up question is, what type of work are you going to be doing in Florida? Because the financing needs to be dependent on your income. And if your income requires you to be in an office where you're currently at in New Jersey, but you're moving to Florida, you got to have that income, that stable Florida income already dialed in. Maybe you work remote, and so maybe it doesn't matter where you're at. But if you don't, if you work physically in somewhere in New Jersey, you're going to have the job lined up so you get the loan down in Florida. You know what? This is good. It's a good question, Will. Probably only cold calling I did was 2014 when I was brand new. And I was so hungry as a mortgage broker just to get things started, to get my business rolling, that I was working a lot. And it was 2 or 3 networking meetings a week where I was meeting a bunch of people. As with most things, like, it doesn't all happen right away. You can be nice, you can be charming, you can be trustworthy, you can be knowledgeable, but people aren't going to refer you mortgage clients, after they met you 2 weeks ago. So it takes a little bit of time for that stuff to kick in. So I was cold calling, 40 or 50 people a day. You know what happens when you cold call people in the day? You talk to everybody who doesn't have a job. Oh man, I remember some of the people that actually spent the time to talk to me. None of them qualified, looking back. I specifically remember an old gentleman who went by Spike. And he told me he had that nickname because he worked on the railroad. I talked to that guy for like 9 months, never did a deal for him. We talked about refinance. So I don't believe in cold calling. I just think there's a lot better ways to get business. I know what happens when somebody cold calls me about mortgage. I'll hang up on them. I guess it depends on what specific part of Arizona you're in. I honestly don't know about specific like Phoenix or Scottsdale or the different areas, but my guess is if it's behaving like most markets, it's still hot. It's just not as hot. And a lot of the clients that I talk to are like, hey, listen, I know it's not going to be cheaper. It might have been $420 3 months ago, and that similar house is still going to sell for $415 or $420. But if I'm going against 3 offers instead of 15, I feel better. It's not as competitive. That's what I'm hearing. But if you're hearing conflicting stuff, it's probably the people who aren't necessarily paying as close attention. Because I talk to people all the time that tell me things, and I'm like, well, your statements were true in March and April, and your statements were true if you don't have your finger on the pulse, or your statements are true if you're looking at data that came out that shows closings from I mean, here's something to think about when it comes to real estate. The condition of the market in March and April, when people are shopping and then getting into contract and then taking 45 days to close. Let's say they get into contract April 15th and they don't close until June 1st. And then June's data doesn't come out until August. We're talking about a May shopper and we're looking at the data in August. That's a long ways away. Talk to a mortgage broker that's talking to 150 buyers every single month, and I'm talking to 55 agents every single month. I'm probably gonna be able to tell you about that May and June season in real estate and how things are feeling way before August and September. But if people are looking at data and they're like, oh, well, gosh, it says that, in June, this closed and this many closings, that data is old, very old. Unless you're talking to somebody with a finger on the pulse. Medi, I don't think we have 45-year loan. Everyone wants to know if we're going to have 40-year loans because modifications are happening where we give people 40-year loans. Where we give, like I'm some giver of loans, like I'm some servicing department where I'm just giving them out. Servicers are able to modify people into 40-year loans. Those loans, I wouldn't be surprised if in the next 24 months a 40-year loan came out. Some lenders supposedly have them. I haven't seen them, but I don't see 45-year loans. No. Del J. I'm going to try to answer this one honestly, truthfully, and with my best effort, even though you probably know that I don't know for sure. But here's what I'm going to tell you. I think that in 2022, here's my best guess. It's going to be less competitive than it is right now. So if one thing that's frustrating the heck out of you is that you're getting outbid, and it's just like, it's frustrating to go out there and look at a house and put an offer on a house and not get accepted. That's going to be easier in 2022. What I think is also probably going to be true is that prices will be at where they're at today or 3 to 5% more. We're not going to see the continued depreciation that we saw in the last 12 months, where the first half of 2022 is like 8 or 10% higher than what it is right now. I think that pace of growth, that pace of price appreciation slows down. So it's similar or slightly more expensive. Let's just call it the same. Here's where it might hurt you though, is if rates are 3.25 versus 2.625 or 2.75. Eventually the Fed is going to have to do something. They have just danced around forever and ever and ever on buying mortgage-backed securities like it's going out of style, keeping rates low. And eventually they're going to have to taper. They're going to have to let rates tick up. And if they do that and you buy a house for the same price the first half of 2022 that you could buy it for now, but you buy it at a rate that's 0.5% higher, you're paying that extra $200 a month for the life of the loan. Depending on the loan amount and stuff, right? That's my best guess. Dakota, thank you. Thank you. Yes, they are real. No underwriting, no origination, no point mortgages, no cost. I got them out today. You ready? Just like all the other smoke and mirrors you see, I can offer you the par interest rate. And we ran a scenario earlier, right? Where it was like 2.67. And with that 2.67, I'm going to charge you $1,055 in underwriting. I won't charge you origination because there's no points on that loan. But there's going to be title fees of $1,200 or so. There's going to be prepaid taxes and insurance. Or if you're like, listen, like I don't want to pay any fees at all, Matt. I don't want to pay that $1,055. I don't want to pay any title fees. I'm looking for a no fee loan. I'm like, I got you. I got the no fee loan all day. It's not special to me. It is called the Okie Doke 2.875. And I'm just giving you a random number. Depending on your credit score, your down payment, all that stuff, the rates are going to vary, right? But instead of 2.67, I bump you up to 2.875. That 2.875 is going to offer $3,000 in credit. Covers that 1055, covers the title fees, even covers some of your prepaid interest and some of your taxes and insurance. And that's how lenders offer no-cost loans. The whole idea of no-cost loans is such a great marketing technique because people are like, oh man, this guy's offering me a no-cost loan. Yeah, he's offering you a slightly higher rate that offers lender credit to cover the costs. That's all it is. It's great. Great way to market. How much does taking out a HELOC impact your credit? Shouldn't affect it too bad. I mean, it's another credit line. And so there's so many things that go into credit that I should probably not even answer this because I'm not a credit expert, but it's taking it out. I mean, like just getting the line without actually putting anything on that line. I don't think it would affect your credit that much. You know what? I'm going to pass on this question. I don't think it affects your credit very much, but I'm just some guy on YouTube. All right, Will, you want to know how long did it take me to start closing 10 loans in a month? Another good question. You know what's funny about my trajectory is I feel like I worked harder than most. I put in more time, effort, energy than most. I wanted to get better, faster. And still, it took me years before I was closing 10 loans a month. And I think that's probably one of the things that newer loan officers are like, second year in the business, man, I'll be closing 10 loans a month. Let's do it. And they don't realize with real estate, with mortgage, with anything, I think where you're handling a really important transaction for somebody. This isn't like you're selling candy canes, right? Or boxes of cookies, right? This is like somebody's biggest financial purchase of their life, and they're entrusting you for it, right? If I look back at 2014, was licensed early in 14. So I had about 11 months. I did 27 loans. That's like 2 a month. And then 15, I did 50 loans. That's 4 a month. In 16, I did 85, 7 a month. So 17 was the first year where I did 100 plus loans, and that was my 4th year in the business. Do I know people that got to 10 loans faster? Yeah. Now that I'm 25 loans a month, I feel like a lot of the stuff I did, I'm glad I did it the way I did it, right? Where I wasn't necessarily trying to ramp up as fast as I could. I was trying to play the long game, get better, plant seeds, and do things that would help long-term business. I did a lot of stuff in 14, 15, 16, 17 that now in 2021 is paying dividends. So yeah, 4-ish years. But I would just continue to focus on getting better. If you're getting better and you're adding more value, you're doing more business. It's that easy. Thoughts on the new COVID-19 ALM? Is it worth it, and will it hinder future refinancing? The heck, COVID-19 ALM. What is COVID-19 ALM? Oh, is this what they're calling? You know, it's funny. I haven't even heard of this, which is, I'm surprised this hasn't been talked about more. Advanced loan modification. All right. I don't want to keep everybody in the dark. So, good question. And let's read it together. Some of these programs will hinder refinancing, but I'm all for whatever helps people out, right? COVID-19 advanced loan modification. FHA is introducing a new home retention option. So this is for FHA loans, I'm guessing. Significant payment relief to eligible homeowners. The COVID-19 ALM will be offered to borrowers currently 90 days or more days delinquent or at the end of their COVID-19 forbearance. Okay, so basically FHA has to offer this to distressed homeowners. Oh, okay. Okay, so here's my thoughts. After reading that, it's literally same verbiage in my head than the stuff that came out from Fannie and Freddie. Fannie and Freddie said, hey, listen up, servicers. You've got to work with clients. When they're exiting forbearance, you better do everything you can to make sure they don't foreclose. Avoidable foreclosure. Another reason why people who are talking about, forbearances ending and mass foreclosures and that affecting the housing market are out of their minds, smoking wacky tobacco. FHA has said it. Fannie and Freddie have said it. They're not going to allow people to foreclose. They're going to offer them whatever it takes to avoid foreclosure. They've said it in letters. It hurts communities. It hurts families. We don't want foreclosures. We don't want a foreclosure wave, a foreclosure crisis. It was bad last time, and we're trying to avoid it. And so, yeah, it's interesting. Thanks for bringing that up. I hadn't even seen that, which is surprising because generally, if I don't see something, people throw it at me and ask me my opinion. So I appreciate you bringing it up, man. Any tips on saving realtor fees when selling? Maybe using Opendoor or Zillow to sell. Man, oh man, you're trying to get me in trouble with real estate agent partners. Being somebody who works closely with a lot of agents, a lot of good agents, I can tell you a good agent is worth their weight in gold. With that said, Opendoor in California is offering ridiculous prices sometimes. And here's what a good agent, here's what I would do if I was a real estate agent. Take a look at an offer from Opendoor, look at all the terms, all the fees, because realize that Opendoor and Zillow are going to charge you as much, sometimes more, than a real estate agent. Because you're like, oh, a real estate agent, 6% commission or 5% commission, whatever they're charging, which is split between the sell side and the buy side. People are like, I don't want to pay all that. And they use a company like Opendoor who charges 7%. They just use different words for it, right? But a good agent, if I was a good agent, I would say, listen, show me what they're going to bring you. If I don't think I can bring you more, do it. I've got rental properties where I allow Opendoor to send me offers because I want to do some market research. Some of the offers they've sent me are bananas. Where if they really gave me that, wow. I mean, I'm not even selling the property. I'm not even thinking about selling the property. But I just look at it and go, wow, $550. So yeah, I mean, that's my best bet. Talk to a real estate agent you really like and trust, someone who's so busy that they don't need your business, or they'll give you the honest truth and say, listen, I don't want to waste your time. I want to be straight up with you. Here's what Opendoor was offering me. If we look at the fees and what my net is, if I listed with you and you took your regular commission, which you deserve because you're the best of the best, would I net more with you? And if they're good and they don't need the business where they can be honest with you, they're say, yeah, I'll beat that, no problem. And if I don't, cancel me in 60 days. Marco Morales. Yep. I'm nervous as heck about rates. They're low, and I just don't see them staying this low. But I've said that for a long time. I'll keep saying it, and rates will keep going lower. That's how I do it for you guys. I just keep predicting that rates have to go up by the end of the year, and then they prove me wrong. Oh, that's cool. So you're self-employed, and you're going to be able to actually expand your business to do more business in Florida, and alimony is going to stay the same. Okay, so yeah, I think it could be good. Connect with a lender in Florida, since it's going to be a while to build. I don't know. Maybe you want to go down there and rent for a year while you're building. I mean, there's a pickup, but there's so many people that have refinanced over the last 18 months that there's really not like a huge new wave, because I'll be honest, that 0.5%, which isn't 0.5% in rate, it's 0.5 in cost. So it's like 50 basis points, where give or take it's an eighth in interest rate. We've seen those fluctuations: 2.875, 3%, 3.1825, or 3.125, 3.25, 3.125, 3%, 2.875, back to 3, back to 3 and an eighth, down to 3. We've seen all this fluctuation of those 50 basis points every other week, right? And so this 50 basis point drop in cost is really not anything special, except for that compared to last week, they're better. So yeah, we'll see more refinance, but I think this is last call. This is last call at the bar. We're like, all right, if you haven't refinanced yet, if you're not sub 3% right now, you better get on this train, because back to this last one from Marco, I don't think we're below 3% at the end of 2021. I could be wrong. I think they do, but it's paid by the lender. So it's one of those things where, like, as a buyer of real estate, let's say you buy a $400,000 house and you see on the closing statement, like, holy gosh, 2.5% on the buy side, 2.5% on the sell side, $10,000 my real estate agent got paid. One, the seller paid it. You didn't pay it, buyer. You got it for free. All their services for free. Two, that agent has to pay their broker. They have to pay the transaction coordinator. They have to pay desk fees. They have to pay for gas. They have to pay for all the other things that go into running their business. So yeah, maybe they made $4,600 helping you buy a house, but you didn't pay it. The seller paid it. Similar thing to a mortgage broker. If I close a loan and the lender pays me $7,600 and you see it shows up and paid by others, whether it's $7,600 or $2,200 or $10,800, it's paid by others. It's not really you. And it breaks down similar to how it would for a real estate agent, where broker gets paid, processor gets paid, my whole team gets paid. I get a box of Raisin Nut Bran at the end of the day. But I like Raisin Nut Bran. It's good. I think let me read the verbiage again, Jonathan. This new home retention option is for those homeowners whom a 30-year rate and term mortgage modification will bring the mortgage current and will reduce the principal and interest portion of their monthly mortgage payment by at least 25%. And so that's what it is. It's not saying that it's a 25% reduction. It's saying putting them in a new 30-year, and lowering their rate. So you know what might happen with some of these modifications? They'll like bring you to a rate, that gives you that 25% savings. So maybe if you're an FHA loan, they're like, listen, we got to take you to 30 years and we got to go to 1.875 rate to get you that payment, that 25% reduction. If you got an FHA loan, talk to your servicer. Your question earlier, like, is it going to mess up refinance loans for me? Yeah, but who cares? Do what's best for you. Do what's best for you every time, is what I advise people. Depends on if that first loan is financed with VA, and I want to use my equity to buy a second home I can live in. So if you're moving to a new primary residence and you want to use your VA loan for that, you can. You might want to look into a cash out refinance with a conventional loan where you're currently at, and then you buy forward with the VA. There's a bunch of different moving parts, you know, how much you're eligible for, how much eligibility you have for your VA purchase, but there's lots in there to unpack. Greatmortgagebroker.com. I almost forgot my own website I set up. Greatmortgagebroker.com. All right, we're over 2 hours. I can't believe how fast these things go. We have so much fun. I'm about to $1.5 million, 6% is 90,000 lost. Lost of us don't make that a year. In Flint, Michigan, 7-8% commission. I mean, if you're selling a $1.5 million house, I hope you're making at least 90 grand a year. But I see what you're saying. You're saying 6% of that's 90,000. It's a lot of money. You're not lying. Appreciate you, Caden. We'll be in touch soon. All right, that's it. I'm out. We've answered all the questions. I appreciate it. I wrote down one thing, the solar panel DTI question. I'll try to get back next week. Justin V, I'm gonna check you out. Make sure you get the VIP treatment. Appreciate everyone that joined. Every Monday, 6 p.m., whether I'm home, away, wherever, 6 p.m. Pacific Standard Time. If you guys have specific subjects you want to cover, I think what I'm going to start doing is having somebody go through and bookmark the different questions we go over, and maybe we'll try to deep dive into like 5 or 6 things. Or if you guys just enjoy this, let me know. And I'm happy to do this where it's like we kind of rapid fire through 40 different questions. I answer the best I can, and I have like dry mouth. I'm talking so dang much for 2 hours. So whatever the case, whatever's going to provide the most value, I'm happy to do it. Thank you guys all for joining. Have a great rest of your evening, and we'll see you next week. Bye-bye.